Have you ever wondered what the difference is between institutional and individual investors? Let's dive into this fascinating topic. First, let's clarify what we mean by institutional and individual investors. These terms might sound technical, but they're actually quite straightforward. Institutional investors are large organizations that invest substantial amounts of money, typically on behalf of their clients or members. These titans of the financial world include entities like banks, hedge funds, and pension funds. They might also encompass insurance companies, endowments, and even certain governmental entities. These institutions often have vast resources at their disposal, including specialized knowledge, research teams, and sophisticated technology. On the flip side of the coin, we have individual investors. These are private individuals who invest their own money. They could be anyone from a college student investing a few $100s for the first time to a seasoned professional managing a portfolio worth millions. Individual investors typically don't have the same resources as their institutional counterparts. They rely more on their personal research, intuition, and sometimes a bit of luck, but don't let the scale fool you. While institutional investors might have more firepower, individual investors are a force to be reckoned with. They bring to the table a unique set of skills and perspectives that can sometimes outmaneuver the giants. You see, the world of investing is a complex and dynamic arena where different players interact. These two types of investors, institutional and individual, play vital roles in shaping the financial markets. They can influence trends, sway prices, and even drive economic growth. As we delve deeper into the world of investing, it's essential to understand these differences. It's like understanding the rules of a game before playing it. You need to know the players, their strengths, their weaknesses, and their strategies. So whether you're a titan wielding billions or an individual with a few thousand, knowing your role and your opponents can make all the difference. Understanding these differences sets the stage for a deeper exploration into the world of investing. So buckle up, because we're just getting started. In the world of investing, money talks. And no one speaks louder than institutional investors. These are the titans of the financial world, the ones who can invest vast amounts of money, enough to make even the wealthiest individuals blink. They are the pension funds, the insurance companies, the hedge funds, and the mutual funds. Their pockets are deep, their influence wide, and their impact on market trends substantial. Institutional investors are like the whales of the financial ocean. A single move on their part can cause a ripple effect that touches every corner of the market. They have the power to drive prices up or down, to create bull markets or bear markets. They can shape economic landscapes, influence government policies, and even dictate corporate strategies. But it's not just their financial muscle that sets them apart. Institutional investors often have access to more sophisticated investment strategies and tools. They use complex algorithms, advanced analytics, and high-speed trading systems to make calculated decisions. They have teams of analysts, economists, and strategists who meticulously study market trends, dissect financial reports, and scrutinize economic indicators. Moreover, institutional investors are privy to information that individual investors often don't have. They are the first to know about a company's earnings report, a change in government policy, or a shift in the global economy. They have the ear of corporate executives and the attention of policymakers. They have a seat at the table where the big decisions are made. But with great power comes great responsibility. Institutional investors are subject to stringent regulatory oversight. They must adhere to strict investment guidelines and ethical standards. They are accountable to their stakeholders, whether they are pensioners, policyholders, or shareholders. So it's clear that institutional investors wield a lot of power. But what about individual investors? Are they merely spectators in this financial game, or do they have a role to play? Stay tuned as we delve into the world of individual investors in the next scene. Individual investors may not have the financial clout of institutions, but they have something equally important: flexibility. Indeed, the world of individual investing is quite dynamic. While these investors might not have the deep pockets of their institutional counterparts, they do possess certain advantages. One of the key strengths is their nimbleness. Individual investors can react quickly to changes in the market, moving in and out of positions with greater speed than larger entities. This agility can prove to be a boon, especially in volatile markets where time is of the essence. Moreover, individual investors aren't bound by the same rules and regulations that institutional investors are. This means they have more room to maneuver, taking on higher risk for potentially higher returns. They can invest in smaller companies, dabble in emerging markets, or even experiment with alternative investments like cryptocurrencies, something that many institutional investors can't do due to their restrictive mandates. This brings us to another advantage: the freedom to make decisions based on personal preferences. Individual investors have the liberty to align their investment choices with their own values, goals, and risk tolerance. They can build a portfolio that reflects their beliefs, whether that means investing in green energy companies to support the environment, or avoiding certain sectors due to ethical considerations. This personal touch is something that's largely absent in the realm of institutional investing. Lastly, let's not forget the power of diversification. Individual investors have the ability to spread their investments across a variety of asset classes, sectors, and geographical regions. This can help to mitigate risk and potentially enhance returns. In contrast, institutional investors are often pigeonholed into specific sectors or regions due to their investment mandates. So, while individual investors may lack the sheer financial firepower of institutional investors, they certainly make up for it with their flexibility, freedom, and the ability to diversify. While they may not have the same resources, individual investors certainly aren't without their strengths. In the battle of influence, who really shapes the market? Institutional or individual investors? This question often stirs up quite a debate among market enthusiasts. Both types of investors hold their own unique sway over the market's ebb and flow. Institutional investors, the colossal titans of the financial world, manage vast amounts of wealth. Their sizable investments can cause large market movements. Picture a giant making waves in an ocean. A single transaction from them can significantly impact the price of a stock, bond, or commodity, akin to a ripple effect. This influence isn't limited to just one sector or market. Their reach extends globally, affecting international markets and economies. On the other hand, we have the individual investor. These are the millions of people making smaller, more personal investments. While one person's decision might not create a noticeable ripple in the market, the collective decisions of individual investors can indeed cause waves. It's like raindrops filling up a bucket. Each drop seems insignificant, but together they can overflow the bucket. Individual investors collectively can influence market trends. For example, a surge in individual investor interest in a particular stock or sector can drive up demand, pushing prices higher. Similarly, if individual investors collectively decide to sell off a specific stock, it can lead to a decline in its price. Then there's the power of the internet and social media. Today, individual investors have platforms to mobilize and act in unison, amplifying their impact. A notable example is the GameStop saga of 2021, where a group of individual investors on Reddit rallied to drive up the price of GameStop shares, causing a significant disturbance in the market. So, in this tug-of-war for market influence, there isn't a clear winner. Institutional investors with their massive capital can move markets, while individual investors with their collective power can steer market trends. The market dynamics are shaped by both these forces, each adding its own flavor to the financial stew. Both institutional and individual investors play a critical role in shaping the financial landscape. So, in the grand scheme of things, who comes out on top? Institutional or individual investors? It's a question that might have emerged in your mind as we explored the intricacies of these two investor types in the earlier scenes. The answer, as is often the case in the world of finance, is not a simple one. Let's recap what we've learned. Institutional investors, the titans of the market, hold significant financial power. They have the ability to influence market trends and steer the direction of economies. Their decisions are shaped by a wealth of information, expert analysis, and a focus on long-term growth. Yet this does not make them infallible. They can be affected by herd mentality, and their size can sometimes limit their agility in the market. On the other hand, individual investors, the solo navigators of the financial seas, bring diversity and dynamism to the market. Their decisions are driven by a variety of factors: personal financial goals, risk tolerance, market perceptions, and sometimes gut instincts. They may lack the resources of their institutional counterparts, but their nimbleness allows them to seize opportunities quickly. However, their decisions can be swayed by emotions, and they may lack the in-depth knowledge required for complex market analysis. As we can see, each type of investor brings unique strengths and weaknesses to the table, and yet they are both integral to the functioning of the market. Institutional investors provide stability and large-scale investments, while individual investors contribute to market diversity and liquidity. The market is a vast, complex ecosystem, and it thrives on this balance. It needs the titans with their massive resources and strategic long-term perspectives, as much as it needs the individuals with their diverse viewpoints and quick response capabilities. In the end, the world of investing needs both the titans and the individuals to keep the markets dynamic and diverse. Whether you're a titan or an individual, there's a place for you in the investing world.